Proper investment placement. Whether planning for retirement or just putting your funds aside, it's probably a good idea to put them in the right place. You know what I mean? First thing I hear is somebody will say, "Oh, I'll invest in an IRA." Well, actually, you invest in a vehicle which you place in a shelter, not unlike, say, putting a car in a garage. Vehicles include stocks, ETFs, those are mutual funds that trade like stocks, bonds, and of course, mutual funds. The stocks, ETFs, and bonds are traded on a daily basis. You can use market, limit, stop orders. And if you're going long, you buy them first, then sell them, hoping for a price rise, and vice versa. Mutual funds, on the other hand, are price takers at the closing price of the day, and thus you don't know the price, so you must start by buying in dollars, but you must sell in units, which happen to be in thousands. Shelters, on the other hand, are types of accounts. Almost everyone would have a personal cash account. While fully taxable, it does have tax advantages, including capital gains treatment and qualified dividends for USA stocks, which are at a lower rate. There are pensions. You have a deferred tax in that case. It does require distribution at the age of 72 if you're no longer working. The maximum contribution now is 22%, up from 20%. Most people, on the other hand, usually just put in about 5%, and if their employer does match it, that's probably the most that they'll match it to. A 401k is for corporate pensions. A 403b is for nonprofits. They don't have a fiduciary. Then there are the IRA accounts. There's a traditional tax-deferred and a Roth tax-free, both subject to the combined limits of now $6,500, or with the catch-up rule for those of you over 50, $7,500 per year. A traditional IRA should be thought like a pension, and indeed is meant for those without a pension, or if you do have one, is subject to relatively low income limits. The Roth IRA is regardless of whether you have a pension and has higher income limits. Lesser but noteworthy other considerations include health savings accounts, which now allow rollovers, and 529 education plans. They happen to be state-specific and are also limited. Of course, there's Social Security, which you can't manage, but do note they are taxed in some states. 85% is at the federal level, and of course, then there's your home. You get an interest deduction, maybe even a one-time exclusion on a capital gain. Let's go through some of the specifics. One gets a return, a yield if you will. Part of it's a capital gain, and part of it is a dividend or maybe rent or interest income. The capital gain gets a favored treatment, as do the USA qualified dividends for middle-class payers at 15% instead of 9 points more, effectively taking a, say, 6% yield for high-income state, making it instead of 4%, 4.5%. The question arises, which is better, the traditional deferred taxable IRA or the tax-free Roth? And it turns out if you get a higher tax bracket at the end, either the state or your income, you'd be better off with the Roth. Also, you set aside for high-income tax folks probably, maybe 50% more. Well, to give an overview summary, you probably should lean toward having your common USA qualified stocks in preferably your cash account. Then you could have bonds, perhaps as a percentage of your age, if you want to sleep well, maybe more, eat well, a little bit less, and or use target dated funds. For the deferred accounts, you have required minimum distributions. I'll show you the graph. It's been recently revised. As for your Social Security, you should really take it at age 66 if you're born before 1960, 67 thereafter. This has been Dr. C Invests.